All right, Bertha, I'll take it here. In fact, we are looking at the latest consumer confidence data, putting a stop to the two-week rally we had seen in the stock market. So are the bulls running out of steam, or is there more room to run in this volatility? Joining us with their thoughts, Jim LeCamp is Senior Vice President of Macro Portfolio Advisors, and Keith Springer is President of Springer Financial Advisors. His book is called Facing Goliath: How to Triumph in the Dangerous Market Ahead. Jim, is the market just tired at this point from the rally we've seen, or is something else going on here in your view?
Well, look, Bill, there hasn't been much conviction to this rally. There hasn't been very much volume at all the way up. At the same time, all the reasons we've been concerned about the markets: falling consumer confidence, falling business confidence, the end of QE, softening U.S. economic data, and accelerating problems in Europe. All of those things still persist. In fact, I would suggest that the problems in Europe are far worse than the market is prepared for. So all of our problems exist. The rally was on very, very light volume. I expect further volatility and a probable undercut of the recent lows.
It sounds like you're in the same camp there, Keith. I noticed in your notes you were saying that you expect about a 10% bounce off the bottom, and we've almost got there. And then we're going to retest the lows.
But that's typical. You always want to retest the lows because that's healthy. You want to see the lows be retested on lower volume, and then we'll shoot to newer highs. We've got to remember what moves stocks. It's earnings that move stocks. And we go through this every single quarter since the rally started 2 or 3 years ago. In between the quarters, the stocks go down because there's no good news. We're always getting bad news about the economy. And then stocks come in and surprise to the upside and push stocks higher. And we're going to see that again this quarter.
But Keith, we had a rather powerful rally last year after Ben Bernanke announced QE2. I mean, it lasted for several months. That wasn't fueled so much by earnings as it was by, it seemed to be, the government coming in on a white horse. Is the market looking for another government bailout this time or not right now, Keith, do you think?
I think it absolutely is, Bill. It's a great question because it is looking. It's addicted to the government stimulus. We've got to remember we still have a lot of stimulus. We've got what I call QE mini-me, which is the proceeds from the bonds. It's still $25 billion a month, which is having a big impact. Low interest rates for 2 more years. That is still government stimulus. But I do think the reason they're doing a 2-day meeting in a few weeks is Bernanke wants to convince the other dissenters to do more stimulus, and I think that's what they're going to push for. But earnings, remember, lag a bit, and earnings are going to push stocks higher.
Jim, even if we do get QE3, would it actually do any good for the market? I mean, isn't this sort of like the law of diminishing returns? You know, if you can't succeed at first, try and try again until it just doesn't work.
Well, that's the playbook of Japan.
I mean, if you look at if you look at what QE2 brought us from an economic standpoint, it didn't bring us anything but higher prices for consumers, and for a short period of time, higher stock prices. Now, look at what the market's doing today after the Evans remarks this morning. Gold is rallying, but the market's lower. The market is very skeptical that this is working anymore. And if the Fed tries this, I think it's going to have very serious negative ramifications. And I think this is one of the problems for the market, is the Fed has painted themselves into a credibility corner, as has the ECB and the IMF. And so these are very serious problems that are going to come to a head. And regarding those earnings coming up for the third quarter, I think we're going to see an adjustment downward for earnings expectations that's going to weigh on this market.
Yeah.
All right.
And also, I see Jim, you see an event coming in Europe. Unfortunately, we don't have time to talk about that, but perhaps we can dig into it another time.
She finishes with a tease.
There
I
you
like
go.
it. Thank you both for joining us.
I've got to keep people watching.